We're going into the back end of 2022. There are a number of factors to consider when looking at how to trade these markets. So we're talking now to a technical analyst who is a fellow of the Society of Technical Analysts here in the UK and has been in the business long enough to know what sort of market we're in. Nicole Elliott, thanks indeed for joining us. It's a pleasure to be able to catch up with you again. We're going to be talking across a number of charts, but I want to get your thoughts first of all on how you view the world from a technical analyst and indeed a fundamental point of view going into the back end of the year.
Well, the main thing is we're coming up to a whole load of important holidays for all sorts of people, which means that a lot of people will not be trading. So there is not the volume, there's not the depth in the market. So that's red flag to a bull. Be very, very careful. And what we're facing is tomorrow's Thanksgiving in the States. Very important holiday for many people, a sad one for other people as well. Then we've got Christmas, New Year, summer holidays in what they're now calling the Global South, right. Which is the updated version of emerging markets, yep. Which is the updated version of Third World, which I find exceptionally insulting, actually. And of course, we've got the football. I don't know if you've been watching the matches, but I mean, what a blazing start with you know, the English team and the Saudi team. Yeah. I mean, it's just stonking, isn't it?
Got some good headlines. So
I mean, loads of goals, you know, it's just...
What does that mean to the markets? I mean, an event like that, you wouldn't naturally associate it with an opportunity to trade. Does it generate feeling or something? What is it that it does? I mean, you talk about the holidays and things. I mean, all these things together, what do they do?
Well, it depends on what your time zone is. But for example, my daughter's in Uruguay, and they're all getting up early in the morning and hitting the beer straight away, you know, because the matches are on very early their time. You know, so it depends where you are and what you're up to. But
so all these events together, what sort of atmosphere in terms of the trading environment does it produce?
Well, I would suggest that your viewers should seriously contemplate what they want to do, what positions they want to hold for the next, say, 2 months. Give yourself 2 months and start doing something about it now.
Right.
You can't wait until beginning of December. Do something now, which means decide which positions you're happy with, whether you feel you've got too much on board and whether you should whittle it down a little bit. Give yourself some time off, because it's always good to clear your head completely. And if anything, turn your charts upside down and see if it makes any difference. Do something different in this free downtime. Do something different and decide a sort of a game plan for what might happen next year.
Let's start then, if I can, with an index, or we're going to be covering a couple of indices. When we set up this interview, I did say that I felt that IG clients were asking more questions about the fact that they were looking at this market thinking, look, we're just starting to go into bull market. We've got the Dow very close to bull market. We've got the DAX in a bull market from the lows we've seen recently. Should we be prepared to accept that now as the trend to continue to go into the back end of the year or not? You've got the Nasdaq here, which actually doesn't look particularly encouraging.
No, I'm afraid it isn't. It's not the end of the world, but what the problem, the key to all stock market problems, and no stock markets are looking bullish at the moment. None at all is up on the year, bar Argentina and Turkey, and there you go, devaluation. So no stock markets are up. This is just one of many, but I think the Nasdaq is leading in that the darling FANGs have fallen out of fashion. They're just completely out of fashion. Some of them have given up half the gains of the last 12 years or more. I mean, it's shocking, isn't it? Others have given up 78% of, you know. So what we're doing is we're dropping down. This year, we've been dropping steadily with a series of successively slightly lower high points, of which this month's one is yet another in the same theme. That's all. Nothing special. Your green 50-day moving average and your red 200-day moving average are clearly pointing down, as they have been since late February. We've got a sort of a trend line, it's okay, and the MACD is very neutral. This is not an extreme move at all. Believe it or not, the pace of the move and the style of the move is not extreme for the Nasdaq as a whole. For individual stocks in here, the big ones, it is extreme. Netflix, Facebook, Meta, you know, those are extreme. And I just don't see this managing to break above the 200-day moving average, really.
It's interesting, isn't it? In the context, we've actually seen a 15% rise from these lows we had back on the 13th of October. That to the high point we saw on the 15th of November, that intraday high was actually, I think it's close on the 15% rally. And that, of course, as I say, does blindside some people because they think, opportunity to get long, keep long, and of course they end up losing money because ultimately it's just a bear market rally.
Yeah, no, what it is, it's the miracle of maths.
Right.
When you start from a very small number, it's easy to double your money.
Of course,
When you start at a very, very big money, you know, a drop of $50 is actually quite a low percentage. This is, be careful. It's the maths.
Well, that goes to further illustrate this. So you would be happy short on these markets, or you think, well, the long term, we're talking here 2 or 3 months.
Cautiously short, but not aggressively, because I know it's probably not going to go anywhere very much. I mean, I can't really see it going below 10,000 or above 13,000 over the next 2 months.
Let's move on to another index that we follow, and that's the S&P 500.
That's right.
Now,
this is the E-mini. E-mini. That's why I like it. It's broader, you know, much broader. I don't like the Dow anymore. I've decided that 30 shares, and then they're all sort of, they're the big old dinosaurs, aren't they? I mean, you know. And it's Chevron, you know, and Exxon, you know.
They turn over the money.
Walmart, you know.
So this is interesting as well. Now, this is a weekly chart. We've just seen a daily for the Nasdaq. This is a weekly chart. So these candles each represent a 1-week period. That's looking quite good, isn't it? I mean, this is rally underway here.
It's a rally, but you can see that the rally we've had, and we're sitting on it exactly, we have retraced 38%, that's a Fibonacci number, 38% of the drop since December. Okay, again, you've got a series of 3 descending, slightly lower highs. I put Bollingers on this one as well, which are the black lines, and you can see that they're neither too wide nor too narrow. They just are. This is quite normal. Again, it's this normal sort of behaviour. The important thing here on this one is that the bounce from October was from the 50% retracement support level, which is taken from the low in 2020. So from
COVID
2020, exactly, COVID low to Dec 21 high, the 50% level is where we based in October. So it doesn't surprise me at all that we've based. You know, you get to that point, it's almost like looking over a cliff edge and you go, are we really going to drop?
Right.
Are we really going to drop? And suddenly you stand back again and decide not to jump, you know? And that's what we're doing at the moment. And again, the rally is going to be a good percentage, isn't it? But that's the way it is.
Maths, indeed.
Interesting that we've, last week, we sort of had a doji, which is a tiny little body with a spike high and a spike low. And that was at the 200-day moving average. Keep an eye out on that level, okay, which is just above 4,000. Keep an eye on that psychological level, whatnot.
So you think it could be capped out of that level? It seems like it is capped out generally.
I think we might stall there again, like we did in sort of not terribly well in the last 2 interim peaks. So I think that's a possibility. So I think possibly this one over the next 2 months you might sort of drift down to 3,600, which is an important support level.
So again, your preferred trade, if I was to nail your colours to the mast, would show a short
on this one rather than the Nasdaq.
Right. Okay.
Because I think the Nasdaq suffered more this year than this one has.
Yeah. One of the big plays in the market has been what's gone on with the foreign exchange markets. And I was talking to IG clients about this just the other day. We were standing here in the studio talking about one of the trades that stood out, and that was the long dollar position. And the long dollar position has sustained tremendous amount of opportunity. If you take your pick of West, exactly where you go long. But I mean, it's come back and it's risen, it's come back and it's risen. Is that going to continue?
It's one of the sharpest moves that I have seen in my living life.
Yeah.
It is one of the sharpest. It's not the sharpest move, but it is one of the steepest, sharpest dollar rallies that I have seen, full stop. So we've gone from 90 on the dollar index.
This is a quarterly chart, isn't it? So each candle represents a quarter.
Yes, and this is something fabulous because it goes back to 1972.
Right.
And that's when Richard Nixon decided not to peg the US dollar to gold anymore. And then the whole thing just went into panic mode. Everything was delirious. But what you can see is here at 115, we're just under the 50% mark, which is 117. At the retracement from the all-time dollar high, which was reached when Mr. Volcker was tackling inflation and he jacked up interest rates to eye-watering levels and nobody could believe it. And so what we've done from the 2008 low, we've retraced half of that huge move, huge. What I then put on there is the mean regression. That's the blue line for the whole of this period, okay? So that's what, 50 years worth. So
how do you calculate the mean regression? What is that? What's it telling you?
It's a mathematical measurement which tries to fit all observed prices in that chart so that the prices then move nearest to that midline. Okay, so it's fitting. It's not a trend line. It's a fitting line. Okay, and then what I've done on the green line at the top, that's 2 standard deviations above the mean, and the red line at the bottom is just 1 standard deviation below the mean. So you see, we've got an asymmetric moves here. The US dollar is more likely to be stronger above the mean regression than weaker below the mean regression. Yes, it's asymmetric, this. Now, what I think is we've probably hit the top in that we're close to the highs of 1972, the highs of 2002, and now the highs of 2022. So it's all the twos. That's interesting, isn't it? It doesn't quite work out perfectly because 84 was a high, but way higher. And then 1992 was a low. And 2002 was lowish. Well, no, 2008 was low. But there's some sort of cyclicality here. There is cyclicality, but it's not perfect. But you wouldn't expect it to be perfect. So the cycle, the regression, and the 50% tells me that this US dollar is way too expensive at the moment, and that I think in short shrift we'll get back down to the sort of 100 level very quickly. So we'll create a spike high this year, maybe. 2022 will be like a spike, and then we'll see downtrends coming up. The other thing just to point out, Jeremy, there's a Japanese rule of 8 to 10, and there's Tom DeMark, 1213, isn't it? Have I got my numbers right?
I know of Tom DeMark, but I don't know.
Okay, the gist of it is, if any market moves in one direction only, in the Far East for between 8 and 10 periods, in the West between 12, 11, 13, the trend is mature and due a correction. And so on that quarterly chart, you can see that it's been moving pretty much in one direction, bar November this year. So I think that might be the turn. That's your turning point.
Okay, well, we'll watch out.
We've got to get through to the end of December to end the quarter, of course.
Okay. All right, well, let's stick with the idea of currencies, because I was fascinated to see that you want to talk about the Hungarian forint. Now, I've been at IG now 9 years talking to clients about this. I think I've possibly spoken about the forint 2 or 3 occasions, and mostly in the context of it being outside the Eurozone for a number of different reasons. And there are some currencies that are outside the Eurozone. Why do you want to talk about the forint against the euro in this context?
Well, there are quite a lot of currencies outside the Eurozone.
Indeed,
I mean,
yes.
what is it? 27 in the EU, and I think it's 17 or 19 under Madame Lagarde's eagle eye. So this is one of many. But what I wanted to show you here.
This is a weekly chart, has to be said as well.
That's
so
right.
Candles.
And if you look what happened, the higher this goes, it means the more forints that you need to buy yourself 1 euro. There's nothing to do with the US dollar, it's the euro huff, as they call it in the FX market. And you can see that in the middle of the first quarter of 2022, i.e. end of February, you suddenly start getting these big blue candles, and that's the Russian invasion of the Ukraine.
Right.
And then it pulls back a bit, normal correction, and then you've got a much longer trend, higher, so a stronger euro, a weaker forint. This is Chimoku chart. Every aspect of this chart suggests that we are to look forward to further forint weakness. And which has been the case since before the Ukraine war. If you look at that chart, you can see that the first blue candle clearly above the cloud is at the end of 2021, so a good 4 or 5 months before the Russian invasion. So there is a tendency here to weakness.
I should say that we've got the Ichimoku cloud on this. You're a specialist in this particular area of the market. It's something that a lot of people don't often talk about. How does it apply, and how do you trade it, given what we've got here?
It is a trending system, so it only works in trending markets. If you're going sideways, just ditch the whole thing. That's number one. Number two, it works well on a daily basis, which was how it was designed, but I find it works fantastically on a weekly basis. Right. I wouldn't do monthly. Don't do that, because you just got too much old data in there. It's a system of moving averages, not quite the same as the Western ones, but they're new moving averages. And the red one is a 9-period moving average, and the black one is a 26-period moving average. And that's weeks, because we've got a weekly candlestick chart. And then you manipulate these two moving averages and you create this thing called the cloud. And so this gives you a whole series of different levels of support and resistance. So unlike a moving crossover, when as soon as it crosses, you've got one signal only and you've got to change tack, this one you can build yourself into a position and then build yourself out of it again. So you're doing it step by step by step. It's not an all or nothing system, which I think is fabulous for long-term trading.
So what's it telling you from where we go from here?
We should go higher on this chart, which means a weaker
euro, weaker forint.
Weaker forint. And what really is interesting here is that the 5-year Hungarian sovereign debt in October got up to 12.86%, and the base rate in Hungary is 13%. So all of this concept about higher interest rates making you want to buy a currency is tosh, isn't it? I mean, sometimes it works, sometimes it doesn't. I mean, most people are saying at the moment that the reason that the US dollar has got so strong over the last year is that the Fed is ahead of the curve in terms of their interest rate hiking ideas. Well, yes and no. Yes and no, isn't it? New Zealand today.
Yes, 75 bips.
And I think that's 4.75% their base rate. I mean, that's a little bit higher than the States, I think. And yet the Kiwi has gotten weaker. So this business about interest rates determining exchange rates, I'd really take that with a good pinch of salt.
Okay, so this is longer, long for longer.
Yeah.
Going on for longer. When talking about the foreign exchange markets, it's always quite interesting to watch, especially about the dollar. It's always interesting to ask questions about gold. Do you have a view on gold, particularly in isolation, or because of this move around in the dollar, is it an opportunity to buy gold on the dollar market?
Looking at the gold chart, this one is priced in US dollars, but don't forget that in Japan they price it in yen per gram, And in India, the biggest buyer, it's in rupees per lakh. Right. So, this is not the only gold chart you can have. Most people look at it like this, so that's why I've brought you this one. Again, it's similar to the others. It's a weekly with Bollingers, and you've got retracement support levels, and we've bounced from the 50% support level taken from the low in 2018. So it's quite a strong bounce, that one. It's a lot sort of perkier. I'd say the beginning of November, it's perkier than the Nasdaq or the E-mini S&P.
S&P, yeah.
So that's important. It stands out, but not massively. 50 and 200-day moving averages are still negative, and rather like the other one, E-mini S&P, we might have peaked against the 200-day moving average. I'm not sure. We've pulled back a little bit, but I'm not sure. Now, the point here is, if I'm correct on my view on the US dollar, that it'll weaken. If gold here on this chart doesn't go up in price, you're losing money.
Yep, of course.
Okay, and this goes not just for gold, but for all commodities, anything, in fact, priced in US dollars. So that includes your condo in Miami or whatever else you've got. Right? So look at this one carefully, but my hunch is that it's not going to go very far in any direction, which has been the case for 2 years now. It's not really trending. Now, that's quite a good thing as a trader. If you're willing to do really hard work and go in and out and in and out, scalping as we used to call it, you can make money here. So just because it's not trending, but you've got to completely change your tactics. Yeah, so with the forint, I would just sell forints and leave it alone. This one, I know I've got to be on here every day having a look at it.
Tight stops?
Tight stops, yeah.
To make sure you don't lose any money in the wrong direction.
Well, it's not really going in any direction at the moment, is it? So you're not going to lose too much. So they don't have to be too tight. But also, don't expect to make a fortune here. No. All this, 3x, 4x, whatever, times your money. Nah.
Let's just round off, if we can, and take a look at what's happening on the crude oil markets. There's a lot of talk going into next year about recession, and if you listen to what Jeremy Hunt said a week or two ago, we're already in recession here in the UK, according to the OBR. This has been quite damaging for oil, because it would mean that the demand side would dry up, relatively speaking, to supply, giving us a lower price. Are you persuaded by the fundamentals? Would you trade this lower?
Well, I wouldn't use the word damaging for starters.
Right.
I mean, I'd say a heck of a lot of people would say, thank God I can fill up my car with petrol again.
That is true.
Thank God I can pay for my central heating.
You are right.
Thank goodness I can export my goods on the tanker. So yes, what's good for one is not. Be careful. Very careful. I'd say for most people, a lower oil price is a good thing. And this is NYMEX, this is New York crude. I noticed that the spread to Europe has been very wide recently, wider than usual. So again, be careful with that. When you hear prices being quoted and things like that, be careful exactly what delivery and what spec you're trading. This is NYMEX.
Is a spot price, isn't it?
This is spot, and you can see that we have traded down
on a daily
since
chart.
June. You've got that Ichimoku cloudy thing again, which is clearly pointing down, although it's going a bit sort of sideways now. Now, my point here is that all my trend lines are really poxy ones. I've drawn really bad ones because all of them only have 2 points of contact. As a technical analyst, I should not have drawn that in, but I was cheating. So already the trend lines are ropey. So just then, when your markets go sideways, any diagonal line will be broken. I guarantee, whatever diagonal you've got, a market that moves sideways is going to be broken. So my hunch here is that we're going to hold inside this large symmetrical triangle. Where the downside at $78, that support is more important than the diagonal on the upside, which is coming in today at about $90 and then drops below that. My hunch is that we're going to zigzag between those two lines. Now, again, this is a great one for trading. If you're prepared to put in the work and have a good look at it, your levels are quite clear. I think there's a good opportunity for nimble people to make money here. And in the meantime, we'll see whether the rest of the world joins Brexit Britain in recession.
Nicole, we've got to leave it there, but thank you so much indeed for joining us. It's a pleasure. Better catch up with you again, having Nicole back in the studio. It's Nicole Elliott, a fellow of the Society of Technical Analysts and a person that's been much followed over the years, and interesting to see what Nicole has to say as we go into the back end of 2022. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.